Good morning, welcome to CATEX-TV. My name is Frank Fortunato. This is a live broadcast from Princeton, New Jersey. Today is another Friday the 13th. It's Friday the 13th of March, 2009. That's what happens when you have 28 days in February. If you need to reach us during the broadcast, phone in toll-free at 1-8667-CATEX. Overseas, the AOL Instant Mail address is CATEX-TV. It's 11:30 a.m. Eastern Daylight Time in the U.S. It's 3:30 p.m. in London. We have a little news this morning before we go into our main news. This morning, the United States received a scolding from, of all people, the Prime Minister of China. Prime Minister Wen Jiabao has voiced concern over the outlook of U.S. government bonds, calling on the United States to ease worries about our assets. Speaking at his annual news conference, that's annual as in one news conference this morning, the Prime Minister expressed concern that massive U.S. deficit spending and near zero interest rates could erode the value of China's bond holdings. China, of course, is the biggest holder of U.S. government debt and has invested an estimated 70% of its $2 trillion stockpile of foreign exchange reserves in dollars. According to the Prime Minister, we have lent a massive amount of capital to the United States, and of course we are concerned about the security of our assets. To speak truthfully, he continued, I do indeed have some worries. I would like, through you, the press, to once again request the United States to maintain their creditworthiness, keep their promise, and guarantee the safety of Chinese assets. It's very interesting. And as if in response, Mr. Prime Minister, some news today that the U.S. trade gap has declined to a 6-year low, $36 billion in the month of January. It dropped about 10%. This is the lowest monthly deficit since October of 2002. The trade deficit was below the consensus forecast of Wall Street economists. They had predicted $38 billion. This is the sixth consecutive decline in the trade balance. Both imports and exports declined in January, and the U.S. trade deficit with China widened even further. This was $20.5 billion in the month, compared with $20.3 billion in the same month last year. Yesterday it was GE, today it's Berkshire. It's another credit agency did them in. Ratings agency Fitch has downgraded Berkshire Hathaway's default rating, the IDR, to AA+ from AAA. It also downgraded its senior unsecured debt ratings from AAA to AA. At the same time, Fitch has affirmed the AAA insurer financial strength ratings on Berkshire's reinsurance subsidiaries, but with a negative outlook. Explaining its rationale, Fitch said that it believes that overall AAA ratings are not appropriate at the holding company level for financial enterprises, given the significant market volatility and correlation of risks recently observed throughout the global economy. They continued, with respect to Berkshire in particular, Fitch cited the company's large unhedged market exposures as a potential source of volatility that is inconsistent with the stability required at the AAA level. Fitch has currently affirmed its AAA insurer financial strength ratings on Berkshire Hathaway's insurance and reinsurance subsidiaries, but with respect to the holding company, Berkshire itself, Fitch views the company's potential earnings and capital volatility derived from its large, unhedged market exposures as inconsistent with the stability required at the AAA level. Such exposures include large concentrated equity investments, as well as exposure to the equity and credit markets through various derivative contracts. Fitch views Berkshire Hathaway's investments in a wide variety of retail, service, and manufacturing companies as mitigating this exposure somewhat, but Fitch does not think that the degree of diversification is sufficient enough to offset the concerns to get the AAA level rating. Downgrade also recognizes that even though most senior obligations at the holding level, that even the most senior obligations at the holding level are deeply subordinated to policyholder obligations at the insurance and reinsurance company level. Finally, Fitch's ratings also continue to reflect their long-standing concerns with respect to so-called key man risk in the form of the company's chairman, Warren Buffett. Fitch views this risk as unrelated to Mr. Buffett's age. I don't know how that's possible, but rather Fitch's beliefs that Berkshire's record of outstanding long-term investment results is intimately tied to Mr. Buffett. In current application of its criteria, Fitch also does not view this concentration as consistent with a AAA rating. Well, Mr. Buffett may be old, but he's still very smart. If you're in Zurich, you're wringing your hands because you learned today just how smart he is. Swiss Re today revealed that it will pay 12% in annual interest on Warren Buffett's investment of $2.53 billion US that he made in the world's second biggest reinsurer. Swiss Re said this morning that the main terms of the convertible perpetual capital instrument to be issued to Berkshire Hathaway have now been finalized. They said this morning that the notes could be converted into Swiss Re shares at 25 francs per share after 3 years, which is about 70% over Thursday's closing price of 14.5 francs. So based on that conversion rate today, Berkshire could end up owning a 25% stake in the company. Swiss Re may redeem the instrument at a 40% premium at any time prior to the 2 years of the issue date. If they do nothing, and if Mr. Buffett does nothing, he will continue to get 12% in annual interest, which is pretty good money. Also, Mr. Buffett has been on the Bloomberg television network for the past 2 mornings in what's a long interview. And today he released some information about AIG. He said that he was offered 2 chances to help AIG before the American government intervened in September. Buffett said that he took a phone call from AIG's then CEO Robert Willemstad, but instead opted not to bid for part of AIG's property and casualty operation. A second offer to Buffett to participate in a transaction fell apart when a cash injection by a private group didn't work out. According to Mr. Buffett, the second deal, proposed deal, involved, quote, an insurance transaction that might have occurred in conjunction with a big injection of funds by some group. At that time, people with knowledge of the discussions were reported to have said that Goldman Sachs, J.P. Morgan, were working with AIG on a possible loan package of $70 to $75 billion before the government rescue plan. Regulators after that, of course, have revised AIG's bailout 3 times. It's now up to about $160 billion. Hanover Re is in the news. They had a press conference in London yesterday. Outgoing Hanover Re CEO Wilhelm Zeller said that the 11% rate increases the reinsurer saw in its U.S. cat lines at the 1/1 renewals are encouraging, but, quote, frankly, not enough. Zeller categorically stated that the global reinsurer would reduce its U.S. property and cat business significantly at the June 1st and July 1 renewals if it could not secure rate increases of 25 to 30%. At the press conference, Zeller said that 25 to 30% rate increases at the June and July renewals is a must scenario based on Hanover's analysis of market conditions. Zeller said that while internal models suggest current rates are up to 125% over what's needed, there's a clear dilemma, he said, between what the models say, what I'm getting, and what I have to earn insofar as the cost of capital. Hanover made some other news. They also said in the same press conference that they do not plan to renew $200 million in securities linked to natural disasters that expired in December because prices of cat bonds are too high. This time it was management board member Ulrich Wallen making the statement. He said that the 3 cat bonds we saw since the Lehman collapse have doubled in prices compared to the times before Lehman collapsed. He said, we are not willing to renew our Kepler Re bonds in these conditions, and we will wait and see how the market develops. The market for cat bonds, of course, was impaired terribly by Lehman Brothers' collapse back in September because some deals relied on Lehman to guarantee returns on securities backing the notes. One issuer, Allstate's Willow Re, did not make a full interest payment last month. That's the second cat bond to default in a decade. Hanover Re sold the Kepler Re securities in March of 2007 to protect against losses from cat events worldwide. That deal expired in December of 2008. SCOR, France's biggest reinsurer, sold the first cat bond since the Lehman collapse last month. That was a $200 million transaction to transfer risk on U.S. quakes and hurricanes. SCOR paid interest of 11.5 percentage points above